Hi, this is Cal from Alpha Beta IR Analytics, and in this work material I will teach you how to apply the franchise valuation model in order to estimate the fundamental value of stocks and make a better investment decisions. Now, before we go to the practical part in Excel, let's first describe what is the franchise value model. This is a alternative valuation model that is very different from discounted cash flows, and it is developed by Martin Weibowitz. Now, according to the franchise value model, the total value of the equity is separated into two parts. First is the tangible value, or this is the value coming from the assets in place. To estimate it, we use Gordon growth model with the assumption that the current earnings per share will be repeating themselves in the future. The more interesting part is the franchise value premium or discount. The idea behind is to compare the company's performance against the expectations and also try to value the growth opportunities in front of the company. The first part is directly derived from the idea of economic profit, where we compare the company's performance measured by the return on equity against the market expectations. As a proxy for the market expectations, we can use the cost of equity since it represents the alternative costs to the company. The second part from the franchise value is the growth factor, where we are valuing, using again the Gordon growth model, the growth opportunities of the company. Combining these two factors, we multiply them by the book value, which is the capital that the company has, and we arrive at the premium or discount to the base value that's embedded. So basically the idea is, if the company has been able to outperform the market expectations, then we're gonna have So the basic idea is, if the company has been able to beat the market expectations and has a good growth opportunities, then this will lead to higher fundamental value. Oppositely, if return on equity is below the cost of equity, then the company is destroying value and we have a discount to the tangible value. Now, this model is very similar to the residual income model, so we're gonna make a quick comparison between the two. The biggest difference is the estimation of the base value. If you remember, for the residual income model, as a base value we use the book value of equity. However, here as a base we use current earnings per share of the company, and with the assumption that they will repeat themselves in the future. The other big difference is that instead of forecasting residual incomes in the future, here we directly value the growth opportunities using the Gordon growth model. Franchise value and residual income models are our favorite models for fundamental value estimation, because first, they are theoretically sound, second, there's a little assumptions in them, and third, they can be applied very quickly across many companies without delving deeper into the financial statements or searching for information about the companies. These qualities makes them perfect for application in the portfolio management, where an analyst must estimate the value of a number of companies in a very short time period. Let's see how franchise value model is applied into Excel. Before that, please read this disclaimer. The example that you see has assumptions that are fictitious, and therefore the results that we're going to show are not to be used in any investment decision, and they are not an investment advice or recommendation. In this example, where I will show you how to apply the franchise value model, we're going to use the Taiwanese public company Quanta Computers, which operates in the consumer electronics sector. Now, let's begin by getting the data from some public database. For this example, I will use the website investing.com, which has a very good database of financial information. I find my company Quanta Computers in the search engine. Then I'll need several things from the financial statement. From the balance sheet, I will need the current book value of equity. This is this field here, total equity. Next, I need the net income data for the last 3 fiscal years. This can be found in the income statement. Turn it on annual basis. And here at the bottom I have my net income. So I'll copy these 3 cells that I will use to estimate the average EPS for the past 3 years. Of course, if you have some other information source on the accounting data, please feel free to use it. And the final thing that I'll need is the current shares outstanding. This can also be found for 2018 in the income statement. So now I'm ready to estimate the model. Before that, now the last thing that I need is the growth rate of the company. I'm going to the ratios tab in investing.com, and then here I have a whole section that measures the growth of the different aspects from the financial statements. The appropriate metric that I need to use is the average growth rate for the last 5 years of revenue, or in this case sales. So these 3.50% are what I will be using as the so-called growth opportunities for the company. Now the growth rate depends on many things. If you have deep knowledge about the future business plans of the company, then you probably can estimate more accurately the growth of the revenue for the next years. And if you don't have such information, you can use these readily available coefficients from public databases, but of course with the full knowledge that they might not be so accurate. Now the last thing that I need to do is to assume cost of equity. I will put 7.5% from the cost of equity for quantum computers. In our website we have a number of educational materials where you can learn how to properly estimate this cost of equity or any other discount rates. And now we are ready to proceed for estimation of the model. The first thing that I need is the average EPS for the last 3 years. What I will do is average the net income for the past 3 years and then divide it by the number of shares, which will give me 3.83 Taiwanese dollars of EPS on average for the last 3 years. The next thing that I need is the book value per share. This is simply dividing the book value of the company on the number of shares. So now we can proceed with the equations. Tangible value is estimated by dividing the expected EPS on the cost of equity. Then we have to estimate the return on equity, which is the ratio between the EPS and the book value per share. Then following the equations here, the franchise factor is the difference between return on equity and the cost of equity divided by the discount rate. The growth factor is again the growth opportunities that we took from the website divided by the difference between the discount rate and the same growth. So finally the franchise value per share will be the combination of these two factors and the book value per share. So the final valuation of quantum computers is the tangible value plus the franchise value, which gives us 62.86 Taiwanese dollars of fundamental value per share. Now, of course, the final stage of any valuation model is to compare our result against the current market price. Going back to the website, we see that the current market price is 56.7 Taiwanese dollars. So if our assumptions are true, then it seems that that quantum computers is a little bit undervalued. However, I have to remind you that the cost of equity, we didn't use any correct model for estimation of cost of equity. I just assumed the number of 7.5%. As you see, application of franchise value model in Excel is very easy. That's why it can be used to find the fundamental value of many stocks in the portfolio. So let's see what are the key points in the model. Of course, the biggest metric is the biggest assumption is the cost of equity, because if we increase it, then the fundamental value drops, because the expectations about the company from the company are a little bit higher, and then it becomes difficult to meet them. Oppositely, if we decrease it, then you see how it works. The most difficult part in applying the franchise value is to get the proper estimate of the growth opportunities. As you saw, I used the average growth of sales for the past 5 years that I took from the website investing.com. Of course, here you can apply some econometric model on past data, or you can simply use the inflation in the economy, and always have in mind that maybe this is the only weakest place in this valuation model. This file is fully automated. If you want to use it on another company, you just have to change the data in the upper table and also the net income. In the end, thank you for your attention. I hope that this unique material has helped you understand the franchise value and also added the skills to apply this very good valuation model. If you want more awesome unique materials, please visit our website. And again, thank you for trusting us with the expansions of your knowledge and financial skills.